Good morning and good afternoon, everyone, and a very warm welcome to today's session, Briefing for Australian Investors, SBTi Investor Net Zero Standards. My name is Kelly Christodoulou. I'm the president of TIDE MRV and founding advisor at the Global Advisory Alliance, and it's my pleasure to be moderating today's session. Before we begin, a quick word on what brought us all here together. In July 2025, the Science-Based Target Initiative, the SBTi, published its first financial institution net zero standard, a framework for banks, pension funds, asset managers, insurers, and other financial institutions to align their lending, investing, insurance underwriting, and capital market activities with a net zero emissions by 2050. For Australian investors, this represents a significant shift and a significant opportunity. So let me walk you through how we're going to spend the next hour. We'll begin with a presentation from SBTi itself. Peter Uhlenbruch, Financial Institutions Engagement Manager, and Pendar Ostovar, Head of Financial Institutions Impact and Engagement, will take us through an overview of the SBTi, its recent developments, why climate target setting remains so relevant and so important for financial institutions today, and a detailed look at the financial institutions net zero standard. They'll also share lessons from institutions that have already gone through this process and the common challenges they face and emerging best practices. And most importantly for this audience, what Australian investors should be thinking about right now. From there, we'll move to a case study from Metrics Credit Partners. Frida Panayi, Director of Responsible Investment and Sustainable Finance, will give us a candid look inside their journey, why they chose to align with SBTi, how they approached the target developments and implementations, and challenges they ran along the way. And this is a great opportunity to hear what it looks like in practice, not just policy. Following that, we'll hear from Lisa Caripis, Senior Manager, Investor Programs at the Investor Group on Climate Change. Lisa will share what she's seeing across Australia, emerging trends, how investor expectations are evolving, and where she sees this all heading. And finally, we'll bring it all today with a Q&A session. So please do start dropping your questions into the chat or the Q&A box as we go along. And with that, I'll hand it over to SBTi to kick us off. Peter, Pendar, over to you. Thank you.
Thank you very much, Kelly. And thank you very much, everybody, for joining us wherever you're based. So we're going to, I'm going to run fairly quickly on around some of the high-level statistics and kind of background on SBTi, which would be of interest to most advisors and asset owners. And Pete is going to do a dive into the standards and provide an overview of our standards architecture as well as our financial institutions net zero standard. Pete, would you please go to the next slide? So SBTi was set up in 2015. We are a charity and we are set up to translate science into standards. So we develop standards, tools, and guidance so that companies would be able to align their actions and set science-based targets to reduce their emissions and align with net zero by 2050. And SBTi has a fully owned subsidiary called SBTi Services, whose job it is to perform a conformance assessment against SBTi standards. And between the two entities, there exists a Chinese wall. So I won't, for example, I sit in the charity, I won't be able to see anything that is submitted for validation purposes that is within the remit of SBTi Services. Next slide, please. So when we look at the growth of SBTi since we were established in 2015, you will see it's been growing fairly fast. And during the course of 2025, we grew by 46% in terms of total validations, corporate validations, and of the net zero validations that grew by 76%, which meant that we ended up 2025 with 40% of our corporate targets actually being net zero targets. The rest are near-term targets, but they're still on a pathway towards a net zero. So it's still the same pathway, but these organizations that you will see at 70% they have not actually got long-term targets. They only have decided to set short-term targets and set actions according to that. Next slide, please. When we look globally, the biggest base of validated companies currently is in Europe, which grew by 43% last year. The second largest base of companies with validated targets is in Asia, and that grew by 59%. And much of that growth is due to supplier engagement targets. So if you may have, for example, Walmart in the United States setting targets, and then their inventory is reduced by their supply chain partners, which may, for example, be based in China or elsewhere. They need to then reduce their emissions so that a lower number flows into Walmart's inventory. And the third largest base of companies in North America, which grew by 41% last year. It's worth noting that North America and Europe pretty much grew at the same rate, despite all the background geopolitical trends. Growth in North America was 41% compared to Europe's 43%. And then if you look at other regions, again, the rate of growth is somewhere between 40s or 50s, albeit starting from a somewhat of a lower base. But there is good progress around the world. Next slide, please. Looking at we asked Oliver Wyman to have a look at all the listed companies globally on all the stock exchanges around the world. And as at the end of 2024, this is a little while back, about a year and a half ago, around 25% of the combined revenue and 41% of the combined market cap was covered with SBTi targets or commitments. And you will see that, if you click, you'll see that there's quite a lot of substantial asset pools that have got validated targets. And speaking with our user experience team yesterday, these companies that, for example, some of them started setting targets a few years ago, they are pretty much vast majority are renewing their targets and moving on to continue their journey with SBTi. Next slide, please. So when we look at stock market penetration, if you look at G7, which is above the dotted red line, you will see that the rate of penetration is decent. So for example, in France, Germany, and UK, the penetration of stock market index constituents in terms of validated targets is actually north of 50%. And if you look at below the dotted line, in India, we managed to achieve 14% of the BSE 200 in terms of validated companies. And even in China, we managed 4%. I think it's worth mentioning that China currently, and during the course of 2025, was the fastest growing country in terms of validated targets with SBTi. So we're starting to kind of get penetration where we have been up until now under-penetrated. Next slide, please. Looking across Australia, there are 109 validated organizations, companies of financial institutions, and 26 further ones committed to set targets with SBTi. And you will see some of the well-recognized names, but within the financial institution space, you will see Bendigo, Bank Australia, People First Bank, and Metrics Credit Partners. And next slide, please. We did a survey in the run-up to the last COP30 in Belém, just to find out, what were people's experience of setting targets with SBTi, and 91% had an overall positive experience. And it's worth mentioning that 80% found that setting targets and actually improve their strategic cohesion and long-term vision when it came down to how they view their forward-looking strategy and how they're approaching the markets and the supply chains and operations. And on the financial side, 76% of the investors in the companies that set targets with us consider that they actually have a higher confidence in the companies with targets. Next slide, please. When we look at financial institutions globally, we have 191 organizations with targets with SBTi, and this is a vast majority is based on targets which are near-term targets, and we developed a standard for that in 2020. And we have 136 financial institutions that have got commitments to set net zero targets with us based on the standard we released last year. And normally it takes around somewhere between 12 months to 18 months, or for some organization, 2 years to set targets. So we anticipate as we move into 2027 that the validations according to the financial institutions net zero standard is going to trend significantly up. I'll pass over to Pete to provide an overview of our standards architecture and also give an overview of our financial institution standards as well. Pete, over to you.
Thank you, Pendar, and welcome everybody. I'm going to talk a little bit around how our standards at the SBTi are evolving, and they're evolving towards more of a modular framework. They're becoming more interoperable. So on the corporate side, we've got the corporate net zero standard that was published in 2021 that covers scope 1, 2, and 3 categories 1 to 14 emissions. That's just undergone a major update. You may have seen it in the press over the last few weeks. I'll touch base on some of those major updates just in a moment. Now, finally, for financial institutions, we have a net zero standard that covers scope 3 category 15 emissions. So these are our two flagship cross-sector standards. They're both underpinned by methods and pathways. And for companies that fall into the harder to abate or heavy industry sectors, we have further guidance and standards for those sectors listed on the right-hand side. So a few weeks ago, we just published version 2 of the corporate net zero standard. It underwent quite a lot of standard development, extensive public consultation and pilot testing, and is designed to really pivot from ambition into action and focus on implementation. We could run a whole 1-hour webinar just on this slide, but just to lift out a few of the key takeaways and to give a flavor of some of the evolution. I think the first thing worth noting is that larger companies are required to publish transition plans, which makes a lot of sense. One of the key changes is to separate scope 1 and scope 2 targets. So these are now treated in more of a nuanced way with more flexible set of target setting methods available to cater for different operational and sector realities that companies find themselves. You can see there's also been an update in the underlying science and pathways informing these. And for scope 3 that's the area we've heard the main challenge from companies on their target setting journeys. There have been some quite important evolutions around the target boundary, which now focuses on significant categories rather than a blanket minimum threshold. And that's also supported by a wider menu of target setting methods, which now also includes alignment. And you'll also be hearing more about alignment in the net zero standard for financial institutions. There's also a new section on ongoing emissions, which is all about taking responsibility for ongoing emissions during the near-term target timeframe. So I'll leave it there. I'd welcome everybody to take a look at the wider range of resources that we've just published to become more informed about the corporate net zero standard. But moving on to our footprint with financial institutions, where we've been active since 2020, we've already had a near-term target setting criteria. We fondly refer this as FINT, and we've had the vast majority of financial institutions validate targets against the near-term criteria. But in July 2025, as Kelly noted earlier, we published our first net zero standard for financial institutions, which is a major leap forward and evolution from the near-term criteria. We've already had 2 financial institutions validate under the net zero standard, and we have over 130 financial institutions that have committed to follow through with net zero targets. So I'm just going to spend one quick slide just to provide a very quick overview of the near-term criteria, mainly to show how the net zero standard moves forward from this. So under the near-term criteria, it focuses on lending and investing. It has a near-term target timeframe of 5 to 10 years. And there's quite a narrow set of eligible methods and metrics that can be used. This includes portfolio coverage and temperature rating, which are very much engagement-led target setting methods, as well as sector decarbonisation approach and a fossil fuel finance policy element. And in terms of coverage, it focuses very much at the asset class level. So now moving on to the net zero standard and how this standard evolves from the near-term criteria, the first thing to say is that the net zero standard covers a far wider range of eligible financial activities. There's still a focus on lending. Investing is still there, though it's been split into asset owner and asset manager investing, recognizing the different approaches there. And it now includes insurance underwriting. For the first time, insurers can cover the asset and the liability side of the balance sheets under the same framework. And capital markets activities are also introduced. So for any of these that individually represent 5% or more of revenue, they're in scope. So this is the most, I think, important slide around the net zero standard. It really speaks to the heart and soul, the theory of change and conceptual framework of the standard. And you'll see that there is an upward pointing red arrow. That is the leading indicator for the standard, and it's all about climate alignment. And it's all about increasing the share of climate aligned financial activities over time. So the question is, what's a climate aligned financial activity? It's essentially a mix of a few different things. Firstly, these are investments that can be considered as in transition or on a path to net zero, and there are two practical ways to figure out if an investment is in transition or not. That's through an implementation list, which I'll discuss shortly, or also applying eligible sector benchmarks within the standard. Secondly, it includes, I think for the first time now, climate solutions explicitly, and they can be identified through the use of eligible taxonomies. And thirdly, it covers investments running at a net zero state. Not very many of those now, but over time we would expect to see those increase. So the grey line, the dotted line going down, that's the lagging indicator. It's portfolio emissions or financed emissions, and that's mainly there to capture the impact of actions taken around climate alignment. But financial institutions still need to disclose and improve the quality of their financed emissions inventory so that when they get to 2050, they can make a credible net zero claim. And it also allows financial institutions to increase their financed emissions in the near term as they essentially buy ground in terms to pivot them to green. So financed emission reductions are the outcome. You will not find financial emissions, portfolio emissions reduction targets, but the intention of the standard is to align finance with pathways consistent with net zero by 2050. So one of my favorite innovations of this standard is what we call the implementation list. And within that are 13 eligible methodologies. Many of these are third-party methodologies that can be used practically by financial institutions to identify in-transition counterparties. I'd really welcome everybody to take a look at this list. It contains a list of commercial as well as non-commercial data providers and methodologies. And these have all undergone screening to make sure that they are in fact rigorous. The list also includes 15 taxonomies that can be used to identify climate solutions, which automatically count towards climate alignment targets. So this is all about interoperability and is quite an exciting development. So in terms of how the standard looks in practice, it's structured across 5 chapters that span the net zero journey for financial institutions. So it begins with a commitment chapter before moving into an assessment chapter, which then moves into target and policy setting, followed by reporting and ultimately target cycle renewals. And it also, there's a chapter referring to net zero claims that can be made along the net zero journey. The standard also requires certain data to be captured and reported on, really important information for financial institutions serious about net zero. So this includes the greenhouse gas inventory. It also includes the climate alignment status of in-scope investments, as well as the share of clean energy to fossil fuel financial exposure and deforestation exposure. So quite a holistic snapshot of data. In terms of policies and target setting, on the policy side, which is another new introduction by SBTi here, there's a mandatory fossil fuel policy, which is all about addressing new financing, not existing financing, new financing of fossil fuel expansion. And in addition to this policy, there's a no deforestation plan, engagement plan requirement, but only if financial institutions have significant deforestation exposure. And there's a third recommended policy which addresses real estate in terms of new financing for buildings and retrofitting existing buildings. On the target setting side, there's a choice for near-term targets between portfolio alignment targets and sector targets. And this is to really recognize the range of financial activities and approaches covered across different financial institutions. So banks might favor and be more familiar with sector targets, while asset owners, managers might be more familiar and prefer the alignment approach. But all financial institutions have to set mandatory long-term portfolio alignment targets out to 2050. So that's the helicopter view of the Fin standard. I'm happy to go into more detail at another time, should there be appetite and interest. But just to finish this, we know there's been a lot of interest in some of the practical practitioner insights around target setting from financial institutions with SBTi. So we thought we'd share some insights. And this is what we've heard from financial institutions in our engagement with the market over the recent pocket of time. I'd say the first real reason why financial institutions still choose to set targets with us is around legitimacy. And as Pendar noted, to validate a target, it has to be validated against quite strict criteria, which has gone through a very extensive and rigorous standard development process. And by aligning with industry best practice, that helps financial institutions mitigate reputational and greenwashing risk. It's very clear and transparent what financial institutions have signed up for. Another benefit we hear is that our frameworks really help financial institutions translate what can be a nebulous idea of net zero by 2050, translating that into near-term, actionable, practical, and measurable steps. So it's a great translation tool for financial institutions. Thirdly, we hear that our standards help financial institutions manage their risks and opportunities. So it's good for figuring out hotspots of risk across a portfolio. It's a great engagement tool, and it can help shift capital into transition finance and climate solutions finance where it's really needed. And lastly, on this front, we also hear that our standards really help financial institutions focus on decarbonising the underlying real economy. It's not about paper decarbonisation of portfolios, it's about addressing the real economy. Some of the challenges and lessons that we've picked up, firstly, we've heard from some financial institutions, one of the challenges is just getting everybody in an organization on board. So some of the lessons learned that were picked up is the value of getting senior level buy-in, the value of focusing on a common goal, such as implementing transition plans, and the value of integrating targets into governance incentives, such as remuneration. We had a great Canadian webinar a couple of months ago where this is one of the case studies that was brought up. I know I've gone slightly over time, so I'll quickly wrap this up. Data is a huge challenge that we hear about. So one of the things that financial institutions can do is to really embed it into the stewardship programs and asks of companies. And for financial institutions that are operating in politically sensitive areas, what we've heard, you've heard a little bit about the business case report that Pendar reflected on, but just to emphasize the focus on managing climate change as a financially material risk is really helpful to keep the eye on the prize of managing this risk. So some key questions for people in the audience who might be advisors or asset owners. First question is, should asset owners set their own targets according to this standard? And we're happy to support any conversations or efforts in that respect. Secondly, to what degree should selected stocks factor in SBTi validation for mitigating a transition risk and driving value? On the debt side, to what degree should there be a pivot towards holding debt from companies that have validated targets? And there are agencies out there such as Euronext that have really good databases of bonds issued by issuers that have validated science-based targets. And lastly, as part of stewardship efforts, which I expect we'll hear about more on this call, to what degree should SBTi target setting be factored in? Plenty more we could talk about. I think we'll stop there. Kellyanne, happy to pass it back to you.
Great. Thank you so much, Peter, Pendar, and for telling us, explaining the SBTi use standards. It's really great to hear that over 130 financial institutions have committed to align with these new standards, and also the practical steps that you've given to us on what financial institutions can take is really insightful. Now, before we move to Frida, I would just like to remind everyone to please, if you have any questions, to put it in either the webinar chat or the Q&A box, which you can find in the bottom right-hand corner under those three dots. And with that, I'll hand it over to Frida to talk about her practical experience. Please, Frida, over to you.
Thank you, Kelly. Hi, everyone. I will quickly give an overview of who Metrics is as a business, so we can frame the discussion better around how we worked towards setting targets. So Metrics is an Australian-based asset manager. Sorry, a bit of lagging there. We are focusing on private debt and credit, and as you will see here, the business has been growing over the past few years and also includes some consumer lending and commercial real estate equity. So target setting and Metrics pretty much predates my time at Metrics. So the business started quite early, around 2021, 2022. That's when the actual targets were set. At that point, I had just joined the business, and Metrics had already started its journey in measuring emissions, both operational and financed emissions. We're a signatory of PCAF, and from my understanding, the buy-in from leadership was quite easy. Leadership wanted to demonstrate ambition, but also accountability. And at the time, the business was considering joining NZEM and also IGCC. So it was seen as target setting being the next natural step, apart from measuring emissions, setting an ambitious goal to progress towards actual reductions. So at the time, we used the near-term standard. The targets that Metrics has set are both operational and also portfolio temperature targets. Hopefully the audience would be familiar with those. Peter briefly touched on the different targets that organizations can set. What that practically means is obviously our emissions footprint, the largest share of it sits in our portfolios and our investment activities. So apart from whatever's happening on the operational side of things, which is essentially an easy transition to renewable energy usage in our office spaces, we wanted to set targets that reflect the reality of our portfolios. And with the temperature setting target methodology, essentially our focus is on engaging with companies to try and communicate our expectations and get them to reduce their own emissions. It's important to note that as part of the journey, you will have to go through the validation process, and Metrics hasn't gone through that because at the time there was the anticipation of the new standard being released. And so an exemption was granted. The new standards have been released now, and it's a reflection of the challenges and the everyday issues that businesses can face. The business itself has really changed on its own. So we had new asset classes integrated in our portfolio last year. So we decided to wait until the end of this financial year to recalculate our baseline and set new near-term and long-term targets that reflect the business better from an operational and portfolio point of view. What we try to focus on is engagement, both within the business, but also externally with our portfolio companies. We try to be very clear with our investment teams, for example, what our targets mean. how we can realistically achieve those targets. So with a portfolio temperature score target, what you want to see is your portfolio companies essentially measuring their emissions and also adopting targets and showing progress on actual reduction. So we think it's very important that our own teams internally know what good looks like and what we want our portfolio companies to be doing. But we've also been working a lot with our portfolio companies as well. A lot of you would know that with private credit or private markets, it might be a bit more challenging. We don't have the same tools as perhaps listed equities, where you get the opportunity to vote on AGMs and engage with companies in a different manner. We try to work a lot with the businesses in our portfolio, especially the ones that in that mid to smaller size. As you would expect, there's a lot of challenges in that side of the business where you might not have the right tools or expertise within house or resources. So what we've done recently was we've partnered with a third-party provider and we launched a pilot program. As part of that pilot program, we helped a number of our private portfolio companies actually measure their emissions, understand what the process is to capture that data. Everything from setting your boundaries to understanding what scope 1, 2, and 3 emissions are and measuring at least scope 1 and 2 emissions. It was a very interesting pilot program that has wrapped now. And as part of that, we've also had a lot of discussions about target setting and seeing an actual improvement in emissions and their trajectory for those businesses. So that's a very quick overview of what we've done and some of the tools we're trying to implement to achieve our targets. So with the end of this financial year, as I mentioned before, we will be looking to revise our targets. We're going to be using the new standard, and we are hoping to make sure that we have a really good coverage across all asset classes. But key takeaways, I think, are that it is a journey. You need to have a good understanding of your own emissions profile. You'll have to have a good understanding of the actual standard itself. And then there's a lot of thinking that needs to be done about how we are actually progressing and improving against our targets. Our targets were a good opportunity to build our climate strategy a bit further, think about these issues and consider what are realistic steps at achieving those targets. I'm happy to say that we have been measuring progress against our targets, our near-term targets, for the past about 4 years now, going on to 5. And we have seen a steady decline in that portfolio temperature score. It's not a dramatic decrease, but it's forward-looking movement, which is encouraging at times. So perhaps, Kelly, I might leave it there, and if there are any further questions, happy to take those.
Perfect. Thank you so much, Frida. It's great to hear that metrics and your pilot program with those private companies and how you are working with them. And when we're looking forward to your new climate targets under the new standard. So thank you so much for sharing. Again, if there's questions for Frida and metrics, please put them in the Q&A box or in the chat here. So now we will turn over to Lisa at IGCC and listen to her perspective. So Lisa, over to you. Thank you.
Thanks very much, Kelly, and good afternoon, everybody. I'll keep my comments pretty high level. What I'm seeking to do today is to let you know what we're observing both at the global stage when it comes to investor target setting and also locally with our members here in Australia and New Zealand. So a bit about us, the Investor Group on Climate Change. If you haven't come across us before, we are an industry body for institutional investors in Australia and New Zealand, looking to safeguard the retirement savings of close to 16 million people in those countries. So we're working to accelerate progress towards a climate resilient economy that's on track for net zero emissions by 2050. Our members, some of you are on the call today, great to see you. They include Australia's and superannuation funds, asset owners across the two countries, asset managers and their advisors and data providers. As for me, I sit in the investor practice team, and a lot of our work is really focused on supporting members with their climate strategies. One of the ways that we do that is through our global connections. We work with other investor networks, such as our equivalents in Asia, North America, and Europe, the UK, as well as global partners such as PRI, to support target setting and climate action in a number of forums. And one of those is the Net Zero Asset Managers Initiative. So just want to mention briefly there, you'll be aware, or you may or may not be aware, that the SBTi standard from the near-term target standard that, target criteria that were developed some time ago, and now the standard itself. It's one of 3 endorsed target setting methodologies under the Net Zero Asset Managers Initiative. This initiative relaunched at the start of this year in February, following a strategic 6-month review throughout last year with asset managers and key stakeholders, and that being primarily, of course, asset owners, around what role an initiative for asset managers on climate has to play now, 5 or 6 years since it was established. We relaunched with 250 signatories, a really strong showing of the fact that there is the industry and the market sees a role for a platform whereby asset managers can make public their voluntary net zero commitments and near-term targets around climate. And we saw 50 asset owners come out very publicly in support of NZAM and encouraging their managers to stay involved / sign up. We've seen a number of asset managers join the initiative since we've relaunched. Just want to mention a couple of things about target setting under NZAM for those who aren't familiar. The NZAM commitment statement itself, it remains anchored in the temperature objectives of the Paris Agreement. That language is in there, along with managers committing to support the global goal of net zero greenhouse gas emissions. In terms of the target setting, that remains one of the key actions for signatories, and within 12 months of becoming a signatory to NZAM, they're expected to submit their near-term climate targets, and those targets should be consistent with the global goal of net zero greenhouse gas emissions, using one of the 3 endorsed target setting methodologies, and those targets should be reviewed periodically, we say within 5 years, to reflect evolving financial risks, client expectations and practices. So that's on the international front. Very much target setting is still a very key part of the work that the asset manager community is involved in. We heard strong demand for that alongside, and you'll see that in the commitment statement, a number of related implementation actions. So yes, targets, but not only targets. Let me come to what we're seeing locally in, I'll speak here just really on Australia for now. Members of ours and some of observers know that we run in-depth market intelligence via a survey of asset managers and asset owners in Australia. We do an equivalent for New Zealand. The one in Australia has quite a high response rate, around 55 to 60 institutions, so quite deep market analysis compared to some other research out there. We've been doing this for about 9 years, and we look at a whole range of climate practice indicators, of course, target setting being one. The results I've got on the screen are for last year's figures. Tomorrow we're launching our latest report, so keep an eye out for that. If you're an IGCC member, there's you can join the launch tomorrow morning, online or in person in Sydney. But I wanted to mention a few key things around what we're seeing. So net zero as a long-term anchor ambition is really quite prominent amongst asset owners, but it's important that that's complemented with interim or near-term targets, something that is going to get you to that longer-term ambition, help you realize that. That's what lends credibility to that long-term ambition. So this figure here, this is 72% of respondents having an interim target over at least part of their portfolio. And the asset classes there you'll see are the ones where we see the greatest coverage. They have been increasing year on year. We do tend to find, however, that asset managers outpace asset owners when it comes to public disclosure of those targets. So be interesting to see what the results are in the publication that's coming out tomorrow. Look, target setting is it's not a one size fits all, and Peter talked about the different types of targets in the net zero standard under SBTi. I think what we've seen, if I might comment briefly on in terms of the evolution in target setting, is a move to realize that of course, we want to be seeing portfolio emissions decrease, but using that as the sole metric and the sole focus of targets and your metric of progress can potentially lead to unintended consequences, but really it's not a good indicator by itself of investor action on climate. So what do I mean by that? Simply, Peter used the term paper decarbonisation. Simply removing high emitting assets from your portfolio does nothing to slow global warming, which we know can have devastating consequences for portfolio values. We're seeing that. Seems to be a new scientific report every day coming out. So what does that mean for investors? You'll see in all three methodologies previously on the screen a real focus on ensuring investors are using the levers that are available to them. And I think we've seen a real shift in the conversation from early days when methodologies were whether very early in their stages of development, implementation hadn't really started, to emphasize the role of investors in real economy decarbonisation. Peter talks about that alignment through SBTi and certainly asset alignment, looking at whether your investees are reducing their emissions, have targets, have credible climate transition plans in place and CapEx behind that to achieve their targets is absolutely critical. The other element I really want to emphasize on this page, of course, is allocation to climate solutions. So there's particularly a role here for asset owners setting quantitative targets to send a signal to managers to get money into those technologies that are going to drive down emissions. Adaptation, is that the next frontier for climate targets? I'll put that as a question. And just to finish off, I just want to mention targets are an incredibly important direction of travel, but they need to be backed up by plan and implementation. So investor transition plans are very much, we're seeing, coming up for investors themselves as a core component of credible transition plans. I'm going to leave it there. I'm sure there's plenty of relevant questions for the panel to discuss, and I'll hand it back to you now, Kelly.
Great. Thank you so much, Lisa. I appreciate that. And I'm really looking forward to reading the State of Net Zero Investment Report 2026 that's released tomorrow. So now we've got a few minutes left for some discussions, and I'd like to encourage everyone watching to use the Q&A box or the chat for any questions that they have. But let's start with the first one, and this is to SBTi. You both talked about some of the challenges, but what are some of the misconceptions that you've seen institutions encounter when they begin the validation process or this process at all? SBTi.
Pete, if it's okay, I'll have a go first, and then you please compliment. What I miss out. But basically, one of the first things is that people think that our standard is around reducing greenhouse gas emissions inventories. It's not. The targets are based on alignment, and alignment is basically what decisions are you making today. So if you're in an investment committee of a asset owner or asset manager, or if you're in a credit committee of a bank or underwriting committee of an insurance company, what are you making a decision today? Because the emissions inventories are going to be calculated next year. And what you want to do is to make measurable decisions and actions today and track it in real time. And that's the first thing. The other thing that often comes up is it's just like the data, and I don't have the perfect data, then I can't add. And the standard basically says you don't need to have perfect data. You can maybe absolutely recognize that, for example, when it comes down to small to medium-sized enterprises that might be in the portfolio of a bank or an insurance company, you're not going to have perfect data. You may not even have any data right now. That doesn't stop you from actually taking action. But the idea is that by 2030, you should improve that data. And there are ways of even calculating fairly accurately the emissions from the SME component of a portfolio of a bank or an insurance company, as an example. So those are a couple that kind of stick out for me. Pete, I don't know if you have any other ones.
The only thing I'd add is around sort of the time frame for getting ready to submit targets. It can sometimes take a little bit longer than organizations think, especially under the net zero standard. It's been out for a year. We now have 2 validated financial institutions, but it can take 12 months, 18 months to get ready for submission. And there's a lot of important groundwork that investors should be doing, anyway, if they're thinking of setting a target or not. So wrapping their heads around how aligned is their portfolio. This can take quite a bit of legwork and architecture internally to set up. So I think just really sort of wrapping their heads and talking to peers and colleagues and sharing learnings around the practicalities. Yeah.
Great. Thank you both. And the next question is over to Frida. What motivated Metrics Credit Partners to align with SBTi requirements and begin their climate target setting journey in the very first place?
Thanks, Kelly. Yes, it was about ambition. It was about what reliable standards we can use. And in that case, when the business was considering participating in NZAM, as mentioned before, SBTi was one of the standards that was recommended for adoption. But apart from that, I think it was quite well known in the sustainability space. So we wanted to find something that is reliable. Same with emissions measurement. We're using the Greenhouse Gas Protocol for operational emissions. We're using the PCAF standard for financed emissions. So we just wanted to stay on that trajectory and make sure that whatever we go forward with has a robust methodology behind it that can be backed up by science.
Great. Thank you. That is very insightful. And I see another question now is to Lisa. In your view, how are investors balancing long-term climate commitments with the growing geopolitical, regulatory, and market uncertainty that they face?
Yes, it's a very timely question, really. And I think this goes back to thinking about the initial target setting process and who was involved and what it represents for the firm. So for those firms that have thought and appreciate the nature of climate risk and the long-term strategic imperative to deal with what it means for their portfolio, for example, the current spikes in oil prices, for example, would not have a bearing on their targets, because they've gone through that process to really interrogate and have a strong rationale for why they've set their targets in the first place. One of the things that I think is quite instructive, I've mentioned at the end of my comments before about transition plans, and the IFRS, and in Australia AASB climate standard, points out the importance in your transition plan of acknowledging or disclosing assumptions and dependencies. And I think that's a really useful complement to the target and transition plan roadmap that investors and corporates, for that matter, can have. Because what it invites them to do is to take a systems lens to how they're going about implementing their targets, to say, well, I've hit a roadblock here for whatever reason it might be, because of a certain assumption or dependency. What can I do to go about addressing that? And that may require, and this is work we're doing with our members, thinking a bit outside the box, outside the kind of immediate toolkit, and maybe not even in the investment toolkit. That might involve policy advocacy. It might involve engaging in the value chain of your investee companies in hard to abate sectors. So I think just to go back to my very first point, all those mechanisms enable those organisations that have really carefully and thoughtfully gone about setting their target, and the reasons why, for the context of their fiduciary duty, they've set those ambitions and something to work towards in the first place, help guide them through and navigate these times of geopolitical and other uncertainty.
Great. Thank you for that. Thank you. That's very insightful as well. So now I see another question that has come through from Michael Salvatico, who, like Artie, is also a friend of mine. And this is for you, Frida. He asks, how successful was the pilot program to collect and calculate data in terms of companies that agreed to calculate their emissions, and in terms of the percentage of the portfolio?
That's a good question. We focused on a smaller number of portfolio companies at the beginning. The issue of data quality has come up as part of this webinar so far, so it's important to acknowledge that that is an issue that we're battling, I think, as many other organizations around there. If you look outside the listed space and the ASX 2 and 300, you might find that there's not a lot of data coming from companies. There's not a lot of measurement, and that's something we're really battling with. The PCAF standard allows you to have a system to estimate emissions for portfolio companies, so that's been very helpful. Our ambition is and there's a scale for those that don't know. You go from a 5, which is the worst score you can get in terms of data quality, up to a 1. And our objective is to continue improving our data quality score. So that's also what came into play when we're selecting our portfolio companies to participate in the pilot project. We thought about who are our biggest emitters based on estimates. Can we work with them to get actual numbers and see how those compare to the estimates before that? Can we replace that big chunk of estimated data that's contributing a lot to our portfolio with actual numbers? And overall, the pilot program was quite successful. Everybody completed the pilot program. We were able to provide them with the full inventory of scope 1 and 2 emissions, and a lot of these businesses are considering scope 3 measurement and also target setting. That was part of the discussion we had at the end. And it overall ran quite smoothly. We had allowed, from memory, about 3 months from beginning to end to do that training and then data capture. officially. They were notified a few months before that was the window that we're expecting to complete the project in, and everything basically was completed within the expected time frame. So overall, went quite smoothly and was a great exercise because a lot of these teams we worked with had never thought about measurement before or didn't have the tools internally, and it can be quite daunting if you're not in this space. Where do you even start? And hopefully we'll see these companies continue to measure emissions independently going forward and setting targets.
That's great. That's great. Thank you so much. So the final question, and it's to, in the few minutes that we have left, is to all of you. And that is, what role should stewardship and company engagement play in achieving investor climate objectives?
Happy to go first. I think it ties into what we were just discussing. Again, and it's not just private credit where, you enter into a deal and then your ability to dictate terms is quite restricted. After that, you are not an equity investor. But having those conversations and setting expectations is probably one of the main tools we do have for achieving targets when we don't have any other leverage or direct influence over businesses. We do work with businesses, but we also engage with industry associations or government when available to us as an opportunity. So I think it is a critical step in influencing outcomes in this case.
Perfect. Thank you. Peter, Panayi, do you want to go?
Yeah, I think probably maybe one inspiration is from the way Schroders have approached stewardship. Basically, they use temperature scores to identify the highest emitting companies within the portfolio, and they made a list of 700 companies in which they are invested and which they contribute quite significantly to their emissions inventories. And they kind of rank them. Which company is has got high emission, has got a poor score. And then they approach them, and the stewardship has got 4 elements. They said basically, as an investor in your company, you have 4 expectations. Number 1, baseline your emissions. Number 2, set science-based targets. Doesn't have to be with SBTi, but set science-based targets for reducing your emissions. Number 3, develop transition plans to credibly say how you're going to reduce those science-based targets. And 4, disclose. And if you do all of these 4, you will see that you get into a cadence of taking action if you're a company, so that you would be making all the right decisions in your executive committees and in your boardrooms. So, and then you over time will be moving in the right direction.
Great, thank you. Peter, do you have anything to add quickly? And then I'll move it to Lisa.
Yeah, I hope what's come through today is that the net zero standard for financial institutions really enables and unlocks engagement and needs it in order to achieve those targets, particularly around alignment, where a financial institution might find quite a significant part of the portfolio that's not aligned. And just capital allocation on its own won't cut it. We do need real world influence. And then it's really up to the financial institution to decide for themselves what's the most impactful engagement approach, and then report on it as part of their target setting journey. So yeah, look forward to seeing what the next generation of engagement, God knows we need it.
Perfect, thank you. Lisa.
Well, it won't surprise you to know that I'll say yes, it's incredibly important. Stewardship is a fundamental lever. I'd just go back to my earlier comments to encourage advisors and investors to be thinking about beyond bilateral corporate engagement, the other stewardship levers available to them when that's not enough. That policy engagement, whether it's through bodies like us or directly yourselves, thinking about value chain engagement, stewardship can take all shapes and forms. So do think creatively. Thanks, Kelly.
Thank you. Thank you. So thank you so much to Peter, Pendar, Frida, and Lisa for such a comprehensive session. And thank you all for joining us today. On behalf of the Global Advisory Alliance, we hope this has given you a clearer picture of the SBTi Net Zero Standard and what it means in practice for Australian investors. The recording of this session will be available post this on YouTube, and we will send you a link directly where you're able to ask us any follow-up questions. So on behalf of that, I want to thank you and say goodbye. Thank you, everyone.
Thank you very much.
Thank you very much.
Thank you.
Bye.